See, I told you the French downgrade from AAA to AA plus wouldn't matter much, and that Standard & Poor's doesn't have a lot of credibility. Not only was France able to flog 8.6 billion euros worth of bonds last night, but the interest rates it paid were lower than a week ago. Portugal wasn't so well treated, however. Its credit rating was cut to junk status. Its bond yield jumped 2% and its share market fell 1%. Wall Street was closed. The other goodish news around was that Chinese economic growth didn't fall much in the fourth quarter. So far, at least, our biggest customer is having a soft landing. Industrial production and retail sales actually went up in the December quarter, although the usual health warnings apply to China's statistics, which is that it's only 17 days since the quarter ended and China is a big country. Even small countries can't add up these statistics in 17 days. But Rio Tinto also came up with some surprisingly strong production report, thanks to sales to China, and its shares led an advance on the All Ordinaries of 1.6%, which recovered everything lost yesterday and a bit more. Telstra went up 2%, Goodman Fielder jumped 14%, so something's going on there, and One Steel went up nearly 8%. And by the way, here's why the banks are laying off staff. According to the ABS, lending fell 6.5% in November, with big falls in commercial and personal loans offsetting a small rise in mortgages. The Australian dollar jumped a full cent against the US dollar and rose again against the euro. The euro is falling against the US dollar and the Australian dollar is rising against the US dollar. So the Aussie-euro exchange rate is turbocharged. Or if you're standing in Europe, it looks like this. How soon before we're talking about parity with the euro? And that's finance.